Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I want to look at 5 undervalued companies that all pay dividends that you could potentially look into adding to your portfolio for the month of May. We do this every month, so we look at about 5 companies sometimes. We look at sometimes 10 companies, sometimes 6 companies that are all undervalued. And every single one of the companies I'm going to talk about today has a wide economic moat, which means basically they have a competitive advantage. They're all undervalued. They're all great companies in my opinion. So I want to share with you all these companies, but obviously you're going to have to do your own research and make sure that you understand the business model, you understand how their financials and so on. So I'm going to give you the overview, inshallah, and then you take it from there. Now, for those who are new to the channel, and now a lot of you have actually joined the channel recently, for me, the most important thing about what I'm doing right now here is to share my journey. Okay, and my journey so far is the fact that I've got this basically portfolio here on Trading 212 is just above £70,000. It goes up and down every other day, right? You've seen it if you watched the videos in the last couple of days. You would have seen it going to up to 71, coming back down to 69, and so on. But I'm not really worried about the price fluctuation of this portfolio, whether it goes up about 5% or 3%. My goal is, inshallah, to build a quality businesses that are Sharia compliant, that hopefully will pay me some sort of a passive income in the future. That future could be 10 years, 15 years, 20 years from now. And that's my main goal. So I'm trying to find quality businesses that meet the criteria that are set for the portfolio, and then obviously talk about them in the channel and then share it with you guys. And then obviously if you're interested in any of the companies that we're going to talk about, then you're going to have to do your own research. So I'm literally a random guy sharing his journey about Sharia compliant stocks, inshallah. And I try my best. Obviously I'm a human, I'll make mistakes, obviously, but I'm trying my best to make sure everything we're doing here is just basically Sharia compliant, inshallah. So if you haven't joined the channel already, please do so. Subscribe to the channel, like the videos that I've shared with you guys, and obviously join us on the Patreon. I've got a Patreon account, okay, where you can just for £2 a month or basically £4.50 a month, you can get access to all of these things, including the Discord, and then basically where you will meet a lot of brothers and sisters who are like-minded, who are sharing good practice, and obviously I contribute to that as well. So if you're interested, please join us. That will really help the channel. It helps me to kind of get motivated and keep going. So let's start with the basically 5 companies. Okay, I'm going to break down each one of the companies, the details I possibly can, and then obviously I'm going to move on to the next one and so on until we get to the end. And then I'll tell you out of the 5 what companies I own already and ones that I'm thinking of potentially adding to the portfolio, inshallah. So the criteria we're looking for basically is the market cap. So we want to know how big the company is. We're looking for the moat rating from Morningstar, meaning if the company has a wide economic moat, that means, and to be honest, all 5 companies have a wide economic moat today. That means they have a slightly competitive, basically more a competitive advantage basically over their peers or their competitors, if you like. We're looking for the current price. We're looking at dividend yield. So again, I'm trying to build a dividend portfolio here. So we're looking at dividend companies. I also have a non-dividend paying companies that are 2 different companies that I will be talking about today as well. So I'll release that video tomorrow, inshallah. So if you're interested, keep look out for that video, inshallah. Latest increase is basically the dividend increase for in the last quarter, the 5-year growth rate, the payout ratio, dividend history, how long basically the company has paid that dividend or increased that dividend, if you like, the annual payout, how much in dollars we receive every single quarter from that business, safety or total, the safety, the profit margin, the return on equity. We're looking for free cash flow. Again, in this channel, we love free cash flow because that's how companies can actually increase their dividends if they need to. Company can buy back their own shares. The companies, they could do a lot with that money basically. And we look for the total return in the last 10 years. So that including dividend and price appreciation, how much the company has returned on average in the last 10 years. In the next year, estimates, for example, okay, so what the analysts are expecting the company to return in the next year, whether in terms of earnings, and then next 5 years, and then Morningstar valuation, and then fair value. So the fair value will be the price with basically the Morningstar thinks we should be buying at these companies at. Right, so let's have a look at the first company, and that is Mastercard. Right, before I even talk about this company, this is not, a lot of you have asked me the question, and I always answer the same question, right, about Visa and Mastercard. Visa and Mastercard do not deal with the interest side of things, okay? They create the technology behind the cards that are in your pocket. They facilitate the transactions these companies do securely and all of that stuff, and they have nothing to do with the interest and what the companies. If you got a card that's a Mastercard, that basically your bank is the one that sets the interest and all of that stuff. They don't deal with that. That's why we do not invest in banks. We do invest in Mastercard, for example, because they are a technology company, not a bank. So that out of the way, so let's have a look at the company. So it has 365 billion market cap. It has wide economic moat, like I said earlier. $386 per share. $386 per share is basically where the price is at right now. Dividend yield is basically below 1%. So this is one of the companies that if you're interested in dividends, this is not the right company unless you're looking for basically in long term. If you are very young and you've got 20-30 years time horizon, for example, this is probably a good company to invest in. The reason I say that is because the latest increase, okay, was 16%. The 5-year growth rate is 18%. So this is very low right now in terms of dividend yield, but the fact that they're increasing it that much, that makes it worth, right? 11 years of increasing that dividend, so that means they will continue. They'll take pride in doing this, and they will continue doing that. So $2.28 is what you will get. Dividend safety is 99%. Profit margin is 42%, which is really huge. Return on equity is massive, 160%. Free cash flow, we're looking at about $10 billion, right? Total revenue, we're looking at about almost to 22%. Next year, they're expecting the earnings to grow by 18%. And then next 5 years, each year they're expecting the earnings to grow by 18%. Is 1% discounted right now, and it's 389 was where the price should be. Right now we're looking at about $386 per share. So again, another great company in terms of looking their revenue. So we are expecting for basically earnings to grow from this year by the end of this year. So last year was $22.24 billion. The next year is expected. This year we're expecting about $25 billion. So they're heading the right direction, as well as the EPS is actually also heading the right direction. Next company we're looking at Cisco. This is one of the companies that are in my portfolio. $189 billion market cap. This is used to be one of the networking companies. It's kind of diversifying away from that, doing a lot of SaaS models, which is basically software as a service. So this means it's subscription based. It's no longer just buy the product and go away and you deal with whatever. So they're now renting out things. Basically, they're becoming more software side of things. So they are trying to diversify away from the old networking devices to now a lot more software, a lot more and a SaaS model, if you like. $189 billion market cap. It has wide economic moat. $46 is per share is where the price is right now. Dividend yield's got 3.37, which is absolutely huge for this company. Latest increase is 2.6. It's not a lot, but it's something. 5-year growth rate of 6%, which is decent. Payout ratio only 45%, so they have room to improve that dividend. And 11 years of increase in that dividend. You'll get $1.56 if you own a share of this business. Safety is 91%, which is really good. 21% profit margin, and return on equity almost at 28%. This is a solid business. $15.5 billion free cash flow, which is absolutely huge. Total return in the last 10 years, we're looking at about 10%. Let's call it 11%. Next year, 8% growth in terms of EPS, and then following in terms of earnings side of things, and then next 5 years, we're expecting about 7%. 17% discounted right now. $56 per share is basically where the price should be in terms of basically moving forward, according to Morningstar, basically. And in terms of revenue and in terms of earnings, both it looks like it's heading the right directions, from $51 billion basically this last year to $56 billion and then $58 billion. So it's heading the right directions, both of them. So there you have it. That's the second company. Now, what the next company we need to look at is Robot Technologies. This is again another software company. And this company is trading right now $459 per share. 48, almost a $49 billion market cap, and it has wide economic moat, which is really like I said at the beginning, every single one of these companies will have that. Dividend is almost non-existent. It's basically just similar to Mastercard. Again, this company is actually growing slowly, but it's not as basically it's not growing as fast as Mastercard, and it's not a new company or whatever. They used to be actually more, I think this company used to be in the industrial sector, but now it's more became more software company, so they kind of moved to the technology side of things. Right now the dividend, like I said, is almost 0.6, so it's non-existent, but the latest increase was 10% and the 5-year growth rate is 12%, which is really good. And payout ratio is really small, if you like, and they are dividend aristocrats, so that means that this company has increased that dividend 25 years or more, which is really good if you think about it. $2.73 is basically what you will get if you own a share of that business. 98% safety, 50% profit margin, return on equity 18%. This is again another solid business, but free cash flow is the only thing that's holding me back from investing in this company, because I've been talking about this company for a long time and it's under my radar. But the thing is that free cash flow needs to start increasing. At least if you can get to at least $1.5 billion or so, then probably be interested in looking into this a bit more detail. Total return in the last 10 years, we're looking about almost 15%. Next year, 7% growth, then 9%, discounted right now about 14%. 530 is basically where the price should be. The next company we're looking at today is Therm Scientific. This is another company that benefited a lot from COVID, and for that reason the revenue actually went it didn't go down too much, but it went down slightly. 211 billion market cap. It has wide economic mode. 544 billion market cap. Dividend again very basically small, but 17% growth this year. Latest increase 15% in terms of the last 5 years. Okay, payout ratio only 6%, and dividend triggers for only 5 years. They will give you $1.40 for every share of that business that you own. Safety 72%, profit margin at 16%, and return on equity 16%. $5.6 billion of free cash flow. Total return in the last 10 years we're looking at 21%. Next year we're looking at about 12% growth in terms of earnings, and then 9% after that. 7% discounted right now. 590 is basically where the price should be in terms of where the company should be, where Morningstar thinks the price should be. Right, so there's another great company. Dividend almost non-existent, like I said at the beginning, but okay, they have the room to improve. So if you basically quite young and you're looking for a company to invest in the long run, the companies that have been around for a long time, positive earnings and everything else, so almost a $6 billion free cash flow there. Okay, this is probably one to look at. The final company is another one that you probably know that benefited so much from the COVID situation, and that's Pfizer. 217 billion market cap, has wide economic mode. $38 per share is where the price is right now. 4.26 okay, in terms of dividend yield, which is really huge. I've not seen Pfizer be around here for a long time in terms of dividend yield. Latest increase was 2.5. Okay, the 5-year growth rate only 5%, payout only 26%, and 12 years of increase in that dividend. $1.64 is what you will get, and safety 75% and 32% profit margin, 33% return on equity, and they have $26 billion free cash flow right now in the bank. Next year, basically next total return in the last 10 years, we're looking at about 6%. And in terms of next year, we're looking at about 7% earnings, and then growth side of things. And then after that, they're expecting about 15%. Now, we'll check that in a second, okay? So this, again, whenever we do these things, this is the estimation from these analysts, so that could be the truth, might not be. So we just have to really be careful with that, because remember, they are just kind of speculating, if you like. They're looking at the company, what is it done before, and they kind of speculating what it should do in the future. Only Allah knows what might happen, right? But right now it's discounted 20%, and $48 per share is basically where it's at. $10 or more than basically where it is right now. So let's have a look at the Pfizer's in terms of growth side of what the analysts are expecting in terms of growth side of things. So this is Pfizer. We're going to go to the earnings, and then we're going to go to earnings estimate. So this is the website I'm using here, is Seeking Alpha, and if you scroll down, you don't have access to this, but you can screenshot this if you're interested in the business, right? So in terms of EPS, okay, in terms of earnings per share estimation, right, we have, again, we've got up to 10, let's use up to 9 people, okay? So 9 analysts all the way to 22 analysts, right? So they're expecting a decline basically in 2023. 2024, they're saying is about 9%, which is good. And then 1%, about 2% there, 1% plus, okay, like less than 1% decline, and then so on. So as you can see here, that's the where they're getting their average from, if you think about it. Okay, and from $68 billion, okay, if we're looking at, again, the top four here, okay, from $68 billion to 68.32 to 68.76. So it hasn't actually, they're not expecting it to grow massively, and a lot of that is because of COVID, right? This company has pulled forward a lot of their earnings in the last couple of years because they've sold so much of those COVID vaccines. They now kind of suffering because of that. These analysts are expecting this to grow. Obviously, that's not going to happen. So this decline is not because the business has done something completely wrong, but because for 2 years or 3 years, whatever it was selling a product that just came out of the blue. And obviously for that reason it's suffering a little bit more. Okay, and that's all it is, genuinely. Right, let's go back quickly and I'm going to show you the Sharia compliant side of things. And as you can see here, all of these companies are Sharia compliant in terms of the business side of things. In terms of the only one I will say is basically has the higher interest bearing debt is this one here. Okay, these two actually, but that's 15% is okay. My cutoff is about 25%. And again, how much can we actually trust Zoya and whatever? And these days, I'm actually doing a really bit more research into that sort of thing. So I'll share that with you, my thoughts, inshallah, on that side of things. But there you have it, 5 different companies. All of them are great companies, very in terms of quality, amazing companies. They're all undervalued right now, and they have a wide economic moat. So for the month of May, you might want to look at these companies, add it to your watch list, and see if they come down to maybe a price that you, because remember, this is great, but add maybe 5% off your, or 10% depending on your risk appetite, just to kind of give yourself a margin of safety. Have a wonderful day. Assalamu Alaikum.